The big question a lot of real estate investors have is what is happening in the real estate market when it comes to pricing? How much has the market come down? Well, today, John and I are going to be getting into what are today's cap rates, what were they at the peak, what are they today, and how much on a percentage basis has pricing come down when it comes to investing into multifamily investing? And, is this a good time to be buying or not? There's a lot of uncertainty out there right now. There's a lot of people they're sitting on cash, they're really not sure what to do. And the big question is do you take action today? And 2 to 3 years down the road, we're going to be looking back today and say, oh man, I wish I would have bought or not. And that's what we're going to be getting into in today's episode. John, it's great to be here with you.
So good to be here, Mark. What we just went through was really kind of a pricing reset, right? So by reset, we mean, values got repriced downward after the interest rate shock in early 2022, right? So what was happening prior to that is the market was sort of on this huge upswing, really starting post the Great Recession because interest rates just dramatically lowered. And on top of that, there was this sort of 4 or 5 year freeze where a lot of single family homes weren't being built. And so there was just a lack of inventory for single family rentals. And then you add the pandemic into the mix and lower rate environment, and a lot of people started trading and moving. And we also saw another freeze in new construction. So bottom line is it just pushed a lot more people into renting to where the average age of the first time home buyer in the United States went from 27 to 38 in like 2 years. And so that just means more people are renting longer, right? And so everybody was buying anything they could get their hands on. And then in early 2022, the rates started going up very quickly, right? As inflation persisted. And we saw rates triple almost what felt like overnight, but over like a 3 to 6 month period. So a lot of operators out there that had floating rate debt all of a sudden found they had a good deal that was no longer a good deal, just simply because of their debt costs. So really, this is not a crash. In no way was it a crash. It's really more like a recalibration from that low rate environment to sort of a more normal rate environment. Unfortunately, for some operators, they got caught in the middle of that, right? So this is an excellent time to buy, and we're going to dive into why right now.
Yeah. And, just a little bit of context before jumping into the numbers is that at the peak of the market, so 2022, there was a lot of demand, we'll say a lot of attention, a lot of money coming into real estate. And so there was a lot of new building that was happening. Well, the interesting thing is over the last couple of years, those builds that started at the peak of the market in 2022, those are now getting the final, we'll say, cohort of those apartments are getting delivered into the market. And so what's happened though over the last couple of years is there hasn't been a lot of new development, barely any.
Right.
And so once that last wave of inventory comes on, there's like 2 to 3 years runway of like not a lot of inventory, if any, coming out in certain markets. And so it's all about supply and demand. And so when you have not a lot of new supply hitting the marketplace, well, that's going to only help the run back in pricing. And so we've seen pricing come down. And what's really interesting is the next 2 to 3 years, we have a very strong, bright outlook for overall multifamily. And the markets that we're buying in, a lot of these areas, there's still people moving in because of affordability. Like you can get a 13, 14, $1,500 apartment, really nice. But you can't get that in some of these larger cities. So more and more people are fleeing to affordability. More and more people cannot afford to purchase a home in today's market. Everything is becoming more expensive. And that's why we love the middle market. We love the hometown heroes, the firefighters, the police officers that have great jobs and they're just beautiful people. They want something nice, but they want affordable. And so this is where today we see that the market has come down, and we'll go over the numbers next, but from an overall, we'll say environment standpoint, that everything is teed up for a very strong future. And John, maybe you could take us as to how much has the market actually dropped today, and what are your thoughts? Do you think today is a good time to be buying multifamily and acquiring properties in today's market or not?
Absolutely. So you'll see a graph on your screen here, and this is from CoStar. So what it's showing is sales volume and market sales price per unit. So looking at market sales price per unit, in late 2021, values price per unit peaked at just under 270,000 a door. So you can see this huge increase in value starting in 2020 up to 20 end of 2021. So in a 2-year period, pricing really spiked dramatically. So that was greed happening in the market. There were, some cases 100 offers on an asset and bidding prices up, right? Bidding wars started to occur. And then the interest rate spiked in 2022. So you see a dramatic fall, right? And so what basically ended up happening is around 2024, Q1, Q2 of 2024, values were actually 27% below the peak of the market. And they were actually still dramatically lower than before that ramp up, right? And so where we're at today, where we sit as we're recording this episode, is pricing is about 21% below that peak of the market, right? So what's also encouraging is as we see what's happening today, we're already started to see that kind of up curve occur, right? So we bottomed out in 2024, and in 2025 we started to see an increase in that per unit cost. So what's happening is a lot of operators are struggling with deals that they bought, and so they're not really active buying in the marketplace. So there's fewer buyers in the marketplace. So when a quality asset comes on the market, you're able to buy it at well below the peak today, 21% below the peak. In fact, we actually were looking at that when we bought Largo, when we bought the Charleston portfolio, and we worked with a broker, right? And they had access to financials going back a few years, and we were calculating about 30% below peak, right, based on our feedback from brokers and research we did on our own. And so combine that with the replacement cost factor that we often talk about on this podcast, where to build a brand new unit today can be 300 to 350,000 unit, and we're buying in some cases in markets like Augusta, Georgia, at 115 a door. In Georgetown, South Carolina, 95,000 a door. Now these are tertiary markets that aren't going to see 300,000 a door sales prices anytime soon, but combined with the discount from peak values with the discount to replacement cost, I don't think there's ever been a better time to
Mhm.
buy, candidly, in my opinion. So cap rates are another factor. We could dive into those, but in terms of values, right now, this is an absolute opportunity that may not come in another, for at least 5 or 10, 15 years potentially. So it's time to dive in.
Yeah, 100%. And that's where you see that dip when it's at the bottom. That's when you know when the news is all negative, when you're going to conferences and the conferences, everything is negative in the conference about it. And overall, people don't get excited about talking about an asset. That's exactly when you should be buying. And so this is where it's really interesting at the peak of the market, cap rates, like properties were selling at like 3 out of 3 cap, in some cases even lower in some of these
Yeah.
primary markets. Like it was incredible how low these cap rates are. And just remember that the lower the cap rate, the higher the value is.
Yeah.
And so currently today for 4 and 5 star assets, deals are trading in that 5 to 5.5 cap range right now. And then, 3 stars, they're in that 5.75 to 6.25 range. And so the cap rates, there's been expansion on that side of things. And the other thing that we've noticed as well is that you're not getting the same amount of competing offers in these areas. Whereas before you get like 40, 50 offers in on these properties, you're not getting that same number. And then the other offers that are coming in, so you could have even on a really nice asset, whereas maybe it was like 30, 40 offers in the past, whereas now you might get, 10 to 15. There's a lot of those 10 to 15 that are, we'll just say, well below, like not even the running. And
Yeah.
so to get to best and final, you got to really make sure you're not overpaying for property in this market, but at the same time, you're not competing with the same amount of people where you're going to get one or two cowboys that are just going off and, overbidding the same way. And so that makes it so you can actually get better deals in today's market.
That's right. So, why does this all create opportunities? So, when you have a better basis going in, you have stronger downside protection. So, in other words, we're not buying at peak pricing, we're buying at a discount to peak values and a discount to replacement cost. And when you have cap rate compression or stability, small operational wins can translate into meaningful value, right? So just adding $50 a month in additional income on a unit can translate into some incredible value at a 5 cap rate, right? A dollar of NOI translates to $12 a month, right, Mark? Did I do my math correct? It's been
Yeah,
a minute.
so for every dollar increase per month, we're talking about $240 of overall
Of
value
annually. Yeah,
on on an annual.
on
So
an
a
annual
dollar per month
basis.
is 240, or $100 of increase per month per unit is $24,000 per overall value. So yeah,
Yeah.
we're there.
Yeah, that's right. And then when you have that cap rate stability where cap rates start to kind of stabilize, like you're not necessarily having to worry about what's going to happen in 3 to 5 years, right? And so whenever we're modeling a deal, we always do stress testing and we have a cap rate table where we're looking at NOI and what happens if cap rates were to go up or down. But when cap rates stop moving every quarter, underwriting becomes more reliable, bottom line. So we can be more confident in our assumptions. And so when you're a value add operator like we are, when market rent growth even sometimes is muted, like in a lot of markets right now, rent growth is flat. And in some cases, it might even be negative. Now, when we say rent growth is flat or negative, what we're saying is if the property is already achieving market rents, when they go to renew, they may actually achieve a little bit less or the same rent. Where because we're buying deals that have operational challenges or our renovation program will increase the rents, we're sort of forcing that appreciation. We're not just waiting for the market conditions to improve to get that additional rent. Where with a Class A asset, it is kind of what it is. So if rent growth is muted, you may have to do some concessions or have flat rent growth year over year. So our returns really come from our execution, right? So things like occupancy renewals, minimizing our expenses, and turning units with renovations. So these aren't wishful rent assumptions. We're sort of forcing it into existence.
Yeah, right on. And so even in this down market, we only look at properties that cash flow from day one. That's really, really important, is that we want to be able to buy properties that we're not taking money out of our pocket every month to be able to do the renovations. Like we're we do raise the money up front for renovations, but we're not, the property is carrying itself as is. So we're not having to take, we'll say, money out of our pocket to float the assets. And so what happens is when we go in and renovate and the property is cash flow, and we can take the 100% of our dollars that we saved and increase the overall value of the building by doing these renos. So we'll spend anywhere from ten to $16,000 a unit. We'll renovate it, but then we can get another $150 extra in overall value. And so based on that, we know it's going to increase X amount per dollar at the end of the day. So even in this down market, we want properties that cash flow. And when we model out the exit, we want to be very conservative with our exit cap rate, so that we're not being, we'll say, too, we'll say aggressive when it comes down to it. So we want to make sure that even if the market stays stagnant, that we're still going to be able to exit and still get a really good return, 3 to 5 years down the road. And then last but not least, like we want to make sure that when we're buying a property, that based on our skill set that we have, that we can go in and we're confident that we can increase the overall net operating income of the property, which means that we can increase the overall income coming in through rents or other auxiliary income sources, like valet trash, for example, or extra storage units. We can go in and increase value, or we can come in and cut down operational expenses,
Yeah,
such as insurance, or we can hire our lawyer to go in and to be able to help lower our overall taxes, for example, or maintenance or property management. Like we've been able to negotiate a better deal with our property management company that we are very hands on with because of our portfolio size. And that's
yeah.
something we've negotiated with the relationship. So it's got to have an NOI story of us coming in and not just like, setting and forgetting the asset, but we're going to come in and add some muscle and some sweat to be able to increase the overall net operating income and the overall value to get higher returns for
That's
our
right.
investors.
And just to be clear here, this is a reset, not a distress market. Now, there are a lot of properties in distress. You touched on that earlier, and the lenders are kind of doing the blend and pretend thing, and they're working with. But we're going to probably likely see some stuff start to trade in distress. But this was not a crash, right? So on our side, we still have to be thoughtful and make sure we're choosing great assets in good areas that have a great story, right? So you touched on this a little bit earlier, but areas that are seeing population growth, job growth, and affordability as compared to, say, some of the larger markets, right? So where are people moving? It's why we leverage things like Postal Service produces a report on where changes of addresses are occurring. the moving company just flew out of my brain, but
U-Haul.
U-Haul, the U-Haul
Yeah.
index, right? Where one-way U-Hauls being rented, right? And so we look at all these data points along with census data and data from resources like CoStar and others to make sure we're picking the right markets. So you can't just go buy any deal and expect it to go well, to put it bluntly, right? Pricing just means that not everything is on sale. It just means that, there's opportunity, and great assets and great submarkets are still going to be very competitive. So just being cautious not to overbid just to win the deal, right? So there have been a few. We lost one in Charleston that we were a little bummed out about, but we just felt strong about our number, and somebody came in 500,000 above us. And there is a minute where you're like, did we make the right decision? But the answer is yes, we did, because it would have lowered our returns and added more risk to our investors. So, the opportunity is really selective. It's where the basis is right, where the submarket demographics are pointing in the right direction, and the seller is motivated, and our business plan is achievable,
Mm.
bottom line.
Yeah, 100%. We know that we have to believe in what we're buying because these are like 3 to 5 year commitments.
Yeah.
And so we really got to believe that this is a Faris asset and the cost basis we're getting it at, we believe in it from day one. And we're not just, we'll say folding and or turning a blind eye to what the numbers are actually telling us just to get an asset. We don't need that because every single deal we go full exit on, that sits on a track record of either being successful or not. So just to summarize, we're seeing property sales at like 21% on average, but we're seeing some assets even higher than that at 30% discounts. And so we're hitting the bottom of the market and starting to come back a little bit now. So the trough is hit and now we're starting to come back. So this is the time to be buying. Cap rates, depending on, if it's a C, B, or A asset, but anywhere from 5 to like 6.5 cap is kind of the range. And so this is where right now is the time that you want to be getting into the market, because we really believe the data is telling us that 3 years down the road, we believe you're going to be looking back at today and saying, wow, like these assets were at phenomenal prices. I wish I would have bought more real estate, which is one of the biggest regrets of real estate investors. I wish I would have bought more. And you want to be buying more in a down market. And one last thought is that the assets that we're buying in the range anywhere from like 50 to 250 units in this range, this is the crown jewel of real estate. The crown jewel of real estate, value add multifamily properties in the affordable space. This is where you can go in, you can add value, and you can force appreciation while it's cash flowing. And so very low risk, very strong upside. When you can buy at a discount like we're in today, you set yourself up for success. So if you do want to learn a little bit more about how to partner with us on our next opportunity, because these spots fill quickly with the investors that come in, go to fulloutinvesting.com and you're going to find out a little bit more about how we work, our overall full out investing process. And you could book a one-on-one call with either John or myself to find out a little bit more if this could be a good fit. Thanks for listening to the Multifamily Investor Playbook. If you did like the show, you can go ahead and subscribe to the channel or maybe share it with a friend or a family member that you think will benefit from it. Thanks for tuning in. We love and believe in you guys. Keep dreaming and investing big.